lot of concerns right now. I mean, we've got this whole LIBOR crisis that's brewing overseas with Barclays and threatening to drag banks from around the world into it. You've got a lot of concerns about the regulatory environment that's coming. How do you approach this group right now, and fundamentally, how do you feel they're going to do over the next 6 months?
Yeah, there's no question there are a number of overhangs in the banking sector. You hit on a couple of them right there. I think there's very little loan growth. That's a number one concern. And the greatest concern is probably profitability. The loans that are being put on the balance sheets are replacing loans and done so at much, much lower yields. So the margins are down. The regulatory impact is weighing on the banks. You have capital market weakness. And for the larger money center banks who have exposure to Europe, that's going to weigh on their results as well. So that's the overhang. The good news is there are pockets of strength. So as an analyst,
when you talk about those pockets of strength, I was very interested to see you actually chose a Canadian bank. What is it about this specific bank, or maybe even Canada in general and their financial system, that makes you think that they're going to be able to weather some of these storm clouds a little better?
Yeah, so the bank I've chosen is Bank of Montreal. The Canadian banking market has been a safe haven now for a couple of years. The profitability numbers are considerably higher in Canada. But ironically, the reason we like it is because of their integration here in the U.S. So they recently bought Marshall & Isley in Milwaukee. They have a big presence through Harris Bank in Chicago. And these are very fragmented banking markets. And I think there's a number of opportunities to scoop up market share in the near term from some of the more depressed competitors out there. And I think that really, more than anything else, is going to drive Bank of Montreal higher. So that one really sits in our sweet spot. Moving into the U.S.,
Canada, moving on down. All right, Bill Maloney, talk to us from a technical perspective what you're seeing within the financial sector right now, given all these fundamental concerns.
The charts are clearly not attractive in the financial center. Just to throw out a couple names, such as Wells Fargo, which is still loved on the street. It's been in this long-term trading range dating back to 2009, so it basically has a neutral chart, and it's going to have a lot of overhead resistance at that 35 to 38 level, which dates back to 2007. You've got Morgan Stanley, you've got Goldman Sachs, and you have Citigroup all trading below their major moving averages, so those charts aren't attractive. And even JP Morgan, it's a no man's land after the London whale. So overall, the charts are just not attractive in these names.
All right, well, so you'd be selling at this point. Andrew Keene, from an options perspective, what are you doing?
Yeah, I totally agree with Bill. And Bill, I think both of the charts and the fundamentals behind the banking stocks is very negative. I don't understand how the banks are going to make money if they're closing their trading desk and the 10-year interest rate is trading 1.5%. I put a trade on in JP Morgan. We don't know how much their losses are going to be from the European crisis. $2 billion, I've heard as high as $8 billion. Very simple strategy. I bought the at-the-money straddle in the weeklies, which means I bought the at-the-money calls, the 34 calls, the 34 puts. I did this for $1.45. I'm risking $145 per one lot. In theory, you know, the stock can go to infinity. But realistically, I think the stock can retest down to the 31 level. If they come out and their losses are not as bad, it could test back up to this where a gap from 40.5 to 38. So I'm playing movement on JP Morgan for earnings on Friday.
Bill, you look like you want to get in there. Go ahead.
No, I was going to say the only bank that still probably looks attractive is U.S. Bancorp, USB. And I agree with Andrew on JP Morgan. It's a crapshoot. If the loss is much worse than expected, you want to look at the stock at the low 30s. If the loss is not in the $8 billion range, like the worst case estimates, then you're looking back above the 200-day moving average.
All right. Thanks so much to the whole gang. In case you missed it, take a look at the cheat sheet for you on banks. You heard Bill Fitzpatrick say he likes the Bank of Montreal. He actually also likes Wells Fargo. We didn't have a chance to get to that one, but he does like Wells. Okay, Bill Maloney says, forget it. These charts on financials looking really, really weak here. Andrew Keene, he's got a neutral options trade on JP Morgan. He said he's really concerned about the London whale and how big those losses could be for JP Morgan. He's hearing as much as $8 billion.